Welcome back to my channel. In our first video about understanding employment income, we laid the groundwork by covering the basics of what's included in your employment income, along with various taxable and non-taxable benefits and allowances. Today, we're going to tackle some more advanced topics, and then, the exciting part for many, understanding what you can deduct from your employment income. Let's start with vehicle benefits. This comes into play when your employer provides you with a car that you also use personally. The way the taxable benefit is calculated depends on who pays for what. Let's break it down in three different scenarios. Scenario 1. Employer provides the car and pays the operating costs like fuel, insurance, maintenance. Your net taxable benefit here is the sum of a standby charge and the operating costs benefit, minus any reimbursements you make to your employer. The standby charge is essentially the benefit of having a car available for your personal use. It's calculated differently if your employer owns or leases the vehicle. If the employer owns the vehicle, it's 2% of the full original cost of the vehicle, including HST, multiplied by the total number of days you had the vehicle, divided by 30. If the employer leases the vehicle, it's 2/3 of the annual lease payments, including HST, minus any insurance costs included in those payments. There's a reduction in the standby charge if the vehicle is used more than 50% of the time for employment duties, and your personal use kilometers for the year are less than 20,004 or 1,667 kilometers per month if you had the car for less than 12 months. There's a specific formula for this reduction, designed to lower the benefit when personal use is minimal. The operating costs benefit is calculated based on your personal kilometers. If the vehicle is used more than 50% for employment purposes, it's your personal kilometers multiplied by a prescribed rate. For 2025, it's $0.34 per kilometer, and for 2024, it was $0.33 per kilometer. However, if the vehicle is used more than 50% for personal purposes, the benefit is the lesser of that same calculation, or R, 50% of the standby charge. Scenario 2. Employer provides the car, but you, the employee, pay the operating costs. In this case, the net taxable benefit is simply the operating costs, minus any reimbursements you make to the employer. This is less common, as typically the employer pays for the costs if they provide the car. Scenario 3. You own or lease a vehicle, and your employer pays the operating costs. Here, the net taxable benefit is calculated as your personal kilometers divided by the total kilometers driven multiplied by the actual operating costs paid by your employer. Let's stick it into your head. Here is an example. Mark is provided with a car owned by his employer, Greenfield Industries, for both work and personal use. He has recorded the following information for the year. Original cost, including HST, $40,000. Total kilometers driven, 35,000 kilometers. Personal kilometers driven, 5,000 kilometers. Vehicle availability, entire year. Here is the breakdown of Mark's taxable benefits for the year, based on his use of the vehicle. First, determine if Mark is eligible for the reduced standby charge. The percentage of personal use is 5,000 kilometers personal divided by 35,000 kilometers total equals 14.3%. Since personal use is less than 50%, Mark qualifies for the reduced standby charge. The calculation is as follows. Standby charge, 5,000 kilometers divided by 1,667 kilometers per month, multiplied by 12 months, multiplied by 2%. $40,000 times 12 months equals $2,400. $2,400 is Mark's taxable benefit for the year. Now let's calculate the operating costs. Since the vehicle was used more than 50% for employment purposes, the operating cost benefit is the lesser of two amounts. Personal kilometers at the prescribed rate, 5,000 kilometers times $0.33 equals $1,650. 50% of the standby charge, 50% times $2,400 equals $1,200. Therefore, the operating cost benefit is $1,200. The total taxable benefit associated with Mark's use of the automobile is $3,600, which is the sum of the standby charge and the operating cost benefit. Note that the CRA prescribed rate for the operating cost benefit is subject to change. The rate used here, $0.33, is an illustrative example. Next, let's look at employee loans. If your employer gives you a loan with no interest or a very low interest rate, the CRA pretends you earned interest on that loan at a prescribed rate. This difference is called an imputed interest benefit, and it's taxable. For a non-home relocation loan, the benefit is calculated by taking the CRA's prescribed interest rate for the quarter, subtracting the interest rate you actually paid, then multiplying that by the number of days the loan was outstanding in the quarter, divided by 365, and finally by the amount of the loan outstanding. For a home purchase or home relocation loan, it's similar, but you use the lesser of the prescribed rate when the loan was made or the prescribed rate for the current quarter. The CRA updates these prescribed rates quarterly. Let's see an example. Ethan recently relocated from Ottawa to Halifax to accept a new job. On April 1st of the current year, as part of his compensation package, Ethan's employer lent him $180,000. The terms of the agreement state that $150,000 is to be used to buy a home in Halifax, and the remaining $30,000 is to be used to acquire previously issued shares of his employer. Ethan isn't required to pay interest, but must make principal payments of $15,000 on each of August 1st and December 1st of the current year. His agreement specifies that principal payments will first be applied against the home loan until the $150,000 owed is fully paid, with no payments applying to the share purchase loan until then. Assume the CRA prescribed rates for employee loans are as follows: January 1st to March 31st, 4%; April 1st to June 30th, 3%; July 1st to September 30th, 4%; October 1st to December 31st, 5%. Ethan's relocation makes $150,000 of the loan a home relocation loan. The taxable benefit is the difference between the interest that would have been paid at the prescribed rates and any interest actually paid. Since Ethan paid no interest, the full amount is a taxable benefit. The prescribed rate used for this loan is the lesser of the rate when the loan was made 3% and the quarterly rate. For the imputed interest benefit on share purchase loan, the prescribed rate used for the share purchase loan is the rate in effect for each quarter. The total imputed interest benefit included in Ethan's employment income is the sum of the two loan benefits. Total taxable benefit, $3,159.74, home loan plus $904.39, share loan equals $4,064.13. Since Ethan used $30,000 of the loan to acquire shares of his employer, he can deduct the imputed interest benefit of $904.39 when calculating his property income for the year. Note that the CRA prescribed rates are subject to change quarterly. The rates used in this example are assumed and don't reflect current CRA prescribed rates. Now, let's jump to another benefit: stock options. ITA 7 covers the rules. Stock options can be a bit more complex, but let's simplify them. A stock option is when your employer gives you the option to buy a specified number of shares at a specified price called the exercise price for a certain period. An employment benefit arises from stock options when the fair market value of the shares on the date you exercise, the option is higher than your exercise price. There are two main components that impact your income. The employment benefit. This is included directly in your employment income. The capital gain or loss. This occurs when you sell the shares, and 50% of it is included in your net income for tax purposes. There's also a special Division C deduction. If you meet certain conditions, you can deduct 1/2 of the employment income inclusion related to the stock option. This effectively makes the employment benefit taxed similarly to a capital gain, which is often beneficial. The conditions for this deduction are that the shares must be common shares, and there must be an arm's length relationship between you and the company before and after you exercise the option. Now, the timing of when these impacts occur depends on whether your employer is a public company or a Canadian-controlled private corporation, CCPC. For employees of public companies, the grant date, when you receive the option, has no income impact. The employment benefit is calculated and included in your income on the exercise date when you buy the shares. It's the FMV on the exercise date minus the exercise price, multiplied by the number of shares acquired. Any capital gain or loss occurs and is taxed on the selling date when you sell the shares. The Division C deduction is available if the FMV of the shares on the grant date was equal to or less than the exercise price. The timing of this deduction is in the same year the option is exercised. For employees of CCPCs, again, the grant date has no impact. Unlike public companies, there's no impact on the exercise date for employment income. Both the employment benefit and the capital gain or loss are triggered and taxed on the selling date. The employment benefit is calculated the same way as for public companies, but it's reported when you sell the shares. The Division C deduction has two conditions. Either the FMV of the shares on the grant date was equal to or less than the exercise price, or if the FMV was greater, you must hold the shares for at least 2 years after exercising the option. The timing of this deduction is in the same year the shares are sold. Let's visualize all this information in an example. Daniel was granted an option to acquire 1,500 of his employer's shares on January 1st, year 1, when both the exercise price and the fair market value were $20 per share. During year 2, Daniel exercised his option to acquire all 1,500 shares. At that time, the shares were trading at $30 per share. In year 3, Daniel sold 1,000 of the shares at a selling price of $35 per share. Scenario 1. Employer is a Canadian public company. For year 1, there was no impact on net income. No taxable event occurs when the option is granted. For year 2, the employment benefit arises, which is 1,500 shares multiplied by $30 minus $20 equals $15,000. This is included in Daniel's net income for tax purposes in the year he exercised the option. The employment benefit is the difference between the fair market value on the exercise date $30 and the exercise price $20, multiplied by the number of shares acquired. For year 3, there is a taxable capital gain. 50% multiplied by 1,000 shares multiplied by $35 minus $30 equals $2,500. This is included in Daniel's net income for tax purposes in the year he sold the shares. The taxable capital gain is based on the difference between the selling price $35 and the fair market value on the exercise date $30, multiplied by the number of shares sold, and then multiplied by the 50% inclusion rate. Note: a stock option deduction of 50% of the employment benefit, $15,000, times 50% equals $7,500 is available. This deduction, however, impacts taxable income, not net income. Scenario 2. Employer is a CCPC. For year 1, there was no impact on net income. For year 2, again, there is no impact on net income. For a CCPC, the employment benefit is not included in income until the shares are sold. For year 3, employment benefit arises 1,000 shares multiplied by $30 minus $20 equals $10,000. This is included in Daniel's net income for tax purposes in the year he sold the shares. The employment benefit is based on the difference between the fair market value on the exercise date $30 and the exercise price $20, multiplied by the number of shares sold. There is a taxable capital gain, 50% multiplied by 1,000 shares multiplied by $35 minus $30 equals $2,500. This is included in Daniel's net income. The calculation is the same as in Scenario 1. The total impact on net income is $10,000 employment benefit plus $2,500 taxable capital gain equals $12,500. Note: a stock option deduction of 50% of the employment benefit, $10,000, times 50% equals $5,000 is available. This deduction impacts taxable income, not net income. Now, for the part that can save you money. Deductions from employment income. The general rule is strict. You can only claim specific deductions listed in the Income Tax Act, ITA 8. Not just any expense you incur for your job is deductible. Often, for you to claim these expenses, your employer needs to provide you with a special form called a T2200, certifying that the conditions for deductibility are met. Let's look at some significant deductions. Dues and other expenses of performing duties, ITA 81I. This includes things like professional dues, office rent or home workspace rent, salaries you pay to an assistant, and the cost of supplies. It also covers long-distance calls and cellular airtime if they're incurred to earn your employment income. Condition to deduct. Your employment contract must specifically require you to pay for these expenses, and you need that T220 form from your employer. Motor vehicle and aircraft costs, ITA 81J. If you use your own vehicle for work, you might be able to deduct capital cost allowance, CCA, which is essentially depreciation, and interest paid on a loan to purchase the vehicle. The amount you can deduct is prorated based on your employment kilometers compared to your total kilometers driven. These deductions are typically for commissioned salespersons or employees whose contracts require them to incur travel expenses. Again, AT2200 is required. There are limits. The CCA addition limit is the lesser of $32,000 for 2025 plus sales tax, or the actual cost plus sales tax. The interest paid limit is the lesser of $10 per day the loan was outstanding, or the actual interest paid. Employees' RPP contributions, ITA 81M. Your contributions to a registered pension plan are deductible. Just remember, your employer's contributions are not deductible by you. Tradesperson's tool expenses, ITA 81S. If you're employed as a tradesperson and required to provide your own tools, you can deduct tool costs in excess of $1,433, up to a maximum deduction of $1,000 for 2024. A T2200 is required. Workspace in the home or home office expenses, ITA 813. Many people work from home now. To deduct home office expenses, one of these conditions must be met. 1. Your home office is the place where you principally, meaning more than 50%, perform your employment duties. 2. Your home office is used exclusively for earning employment income and used regularly and continuously for meeting customers or other persons in the ordinary course of your duties. The amount you can deduct is limited to your employment source income. This means your home office expenses can't create a loss or reduce your other income. You must prorate your expenses for employment use, typically by square footage or number of rooms. Potentially deductible costs, which you prorate, include utilities, home internet access fees, repairs and maintenance, and rent. However, only commissioned salespersons can also deduct insurance on their home and property taxes on their home. Note: expenses like long-distance phone calls, cell phone bills, and supplies are not subject to the employment source income restriction because they don't relate to the workspace itself. Now here there is some special tips for those who are salesperson. A commissioned salesperson is the only type of employee who may claim deductions under ITA 81F, which often relates to lease costs for a motor vehicle. Their claims under this section are limited by their commission income. If their expenses exceed their commission income, they have an option. They can choose to claim under different sections, 81H and 81H.1, instead. But remember, you cannot claim under 81F if you've already claimed under 81H or 8.1 for the same expenses. And that brings us to the end of our deep dive into employment income. We've covered a wide range of topics, from the basic inclusions and benefits to complex automobile rules, employee loans, stock options, and crucial employment expense deductions. Understanding these rules is absolutely key to navigating your personal tax situation effectively. Keep learning, keep asking questions, and you'll be well on your way to mastering employment income taxation. Thanks for watching. If you found this content helpful, don't forget to subscribe to my channel and leave your like for more videos like this.